Lockheed Martin will be reporting earnings tomorrow morning, October 17, before the market opens. And today, October 16, we detected some unusual options activity that could indicate where the stock will be going. Before we get into it, notice how the stock rallied considerably just recently when the Israel-Hamas war started, because Lockheed Martin is a military defense company, and so that is why it rallied along with other companies in this sector. Okay, so the unusual options activity now seem to imply that Lockheed could potentially come back down. Now, let's take a look at why this data says that. Okay, so over here, we can see the 1,162 options. These are the unusual options we were talking about. They were done at 2:53, expiring this week, October 20. So we know these are earnings trades where they bought the 415 strike puts and sold the 400 strike puts. And they bought it for 102 and sold for 26. So what is that net? 102 subtracted by 26, 76 debit per trade. So $76 per trade times 1,162 contracts. This was about $88,000 trade here. Okay, so not so much in comparison to the unusual options activity we usually follow. We prefer to follow more wealthy traders because they are usually more accurate in predicting stock price movements. Usually we follow trades that are over $1 million. And if you are interested in that type of data where we share the unusual options with our members, make sure to join our membership by clicking the join button on our channel homepage, where we show the stocks that have unusual options activity data that are valued over $1 million. And also, as a member, you also get early access to any of the public videos that we make as well. So here is the October 20's option chain. You can see just 4 days expiring. The 415 strike puts we were just had identified here as they were buying this. You can see that the volume here is much greater than the open interest on this column. Same with the 400 strike puts. Volume is much greater than the open interest. So we know that these are opening trades. Okay, and when we analyze a trade, so they bought this, they sold that, and we know they did this for 76 debit. Okay, so when you analyze the trade, this is what it looks like. Okay, and you can see here as the price over here on the x-axis here, this is the price of the stock of Lockheed Martin, LMT. As it goes down, the profit increases. This is a profit loss diagram, so the curve is showing the profit and the potential loss. If it goes up, then it's a loss. And so max loss is what you pay, which is $76. But notice how if Lockheed were to start dropping below 415, here's the break-even point, it would start to increase all the way up. If it's up to $400, look at the profit, 842. And at expiration, it's 1,424. So that's over 1,000% of profit there, right? Because if they paid $76. If you're turning $76 into $854, that's over 1,000%. Okay, and this risk to reward ratio could possibly be why this trader spent this money to basically short Lockheed Martin. Now, if we take a look at the chart here, that $400 level is right here, right? And this is the price where it was before the war started, right? And so that's why we were saying that this could potentially come back down for whatever reason. But the other thing you want to take into account is that this trader could also potentially have shares, and this was just a hedge, right? So they could have had shares, and that these put options that they bought, just a hedge. We know that one option contract represents 100 shares. So this is what it would look like. So if they had shares that they were holding, and they just bought those puts just to hedge in case of a downside protection from this uncertain earnings risk, you could see that as the price of Lockheed goes up, they will still be profitable even though they bought those puts, right? The puts are just a minor cost to their overall cost of these shares, these 100 shares of Lockheed Martin. It essentially mitigates their loss, reducing it, because you could see here at $400 here, they would be at a loss of $3,183. But if they didn't have the puts, they would be at a loss of $4,000. So that's why they possibly bought these puts. It's to reduce their loss. Okay, so keep that in mind, that this doesn't necessarily mean somebody is very bearish and shorting the stock. And so that's why we don't put a lot of position sizing into something like this. But we still traded it just because the risk reward is so high that it's quite essentially means like you could essentially lose a risk to reward ratio of 1 to 10 means you could essentially just win once and lose 9 times out of 10 and still break even. So we like this risk to reward ratio, and so again, we don't have to put a lot. Just like this trader didn't have to put a lot; they only put $88,000, which is not a lot, right? We see traders putting in millions and millions of dollars, and so we don't think this 88,000 is actually so much for a lot of these wealthy, rich investors that we follow and monitor and trade with. All right, so if you are interested in that, make sure to hit the join button on our channel homepage to learn more on how you can start getting access to this to start beating the market. All right, comment below, what do you think is going to happen to Lockheed Martin for earnings tomorrow? Will it go down or will it go up? And as usual, please smash that like button and subscribe if you haven't. Hit the bell icon and you'll be notified of unusual options activity. Thank you and take care.